take my money.
I think Caleb's speaking on behalf of the school there, as the school doesn't want to give up their money to Calibre Education. Remember what we did in the last lesson when I did the Debtors journal? Calibre Education sold on credit, on account to the school, and then Calibre Education collected the money. The terms were pay within 30 days. But now in this lesson, the school is going to return some of the stock, or they're not happy with some of the stock that Calibre Education sold to the school. So we have an unhappy customer and they're not willing to pay Calibre Education. And remember, we need to build up this relationship with our customer. So we need to investigate their claim for goods which do not comply with the order. So the school is not happy with what we supplied them. So we need to have a look at what the situation is. Remember, find a nice quiet place, put on your headphones, and thanks again for purchasing this lesson. I appreciate your support. Hopefully it's a good one and I don't have to return my money to you. And
Don't take my money.
yeah, don't take my money. I won't take your money. And what we're going to do is we're going to keep sailing down the river along the accounting cycle. Only one more journal to go after this. But in this video, in this lesson, I'm going to concentrate on the Debtors Allowance journal. You might know it as the Sales Returns journal. In our example, the school is going to return goods to us, Calibre Education. Enjoy this little video. As I normally do, let me show you how this lesson fits into the bigger picture. Here we have once again the bookkeeping or accounting cycle, and what we're going to be doing is we did look at credit sales and now we're looking at sales returns, and we're going to look at the documents that are used to record these sales returns, and from the documents we're going to record this information in the Debtors Allowance journal or the Sales Returns journal. And from the journal I will show you how to take that information and put it into the general ledger. There's a typical transaction. Our customer who holds an account with us, we have sold to the school on credit, wasn't happy with the stock that they received and they requested a 20% credit. We have to look at the original transaction. It was on the 9th. This transaction is taking place on the 10th, and we investigated the situation and we granted them a credit. So they're going to get a 20% rebate on stock sold to them. Where are we going to record that? In the Debtors Allowance journal. So that's a typical transaction that will go into the Debtors Allowance journal. There's another one. The school returns stock to the value of 1,500. We're going to credit their account, so we issue them a credit note for the claim on the items that didn't comply with the order. That DAJ stands for Debtors Allowance Journal. Remember, sales returns. We're going to use a document, a credit note, to record this information in the Debtors Allowance Journal. We issue a credit note and we issue the original. We keep a duplicate and we use a duplicate credit note to record the transaction. Remember, I always show you later on in the video a bigger picture of the credit note or any document. And then that information is taken from the document, the credit note duplicate, and it's recorded in the Debtors Allowance Journal. DAJ stands for Debtors Allowance Journal. And then part of the cycle, that information is taken from the journal and posted to the accounts in the general ledger. So that's what we're going to be doing today. I hope you enjoy this lesson. I'm enjoying making this video, and you guys are going to be better off for purchasing and watching this lesson. So let's move on. Before I look at the documents, I've just put in front of us a little bit of information. I've taken all the transactions for the month of February that relate to the school, and all this information was taken on a daily basis to the account of the school in the debtors ledger of us. Remember, we're drawing up the books of Calibu Education, and in this account of the school, every transaction relating to the school is posted to this account, and we will keep a running balance of what the school owes us. So I just thought I'd show you the debtors ledger quickly, but this lesson we're going to focus on the Debtors Allowance Journal, the transactions where the school returns stock to us or we're giving them a rebate, right? So we're going to look at those transactions that get recorded on a credit note that we issue. We keep the duplicate and we put the information into the Debtors Allowance Journal. In front of you, you have all the transactions that Calibu Education, we're doing the books for Calibu Education, all the transactions for February. So all the transactions that we entered into for February. But I've been through them and we're focusing on sales returns from the school, and I've identified on the 10th the school wasn't happy with the stock sold to them on the 9th and requested a 20% credit. We granted their request and issued a credit note. So we're giving them a 20% rebate on the items that were sold to the school on the 9th. So we're going to have a look. Sold more accounting videos to the school, cash, 3 videos at 1,000 each. A trade of 5% discount was granted, and there's a cash invoice. So we're giving them a rebate. I'm going to change something quickly. I'm going to change this here from, this is important, on the 9th, for the purpose of this lesson, I'm going to say the items were sold to the school on credit, on account, not cash. I'm just changing that wording, because if we sold the items to the school for cash, we definitely don't want to go and credit their account, because they're actually not owing us any money as a result of the transaction that took place on the 9th. So I'm changing this here for the purpose of this lesson to, on the 9th, to a credit sale of 3 videos at R1,000 each. There was a trade discount. So the school on the 9th bought stock from us, or videos from us, Calibre Education, on credit. The school wasn't happy with the videos purchased and requested a 20% credit. So we're going to record that in the Debtors Allowance Journal. Also on the 16th, the school returned stock to the value of 1,500, issued a credit note to accept the claim for goods which did not comply with order. So we're going to look at that transaction on the 10th and a second transaction on the 16th. So those were 2 examples where we need to credit the account of the school. These are more transactions relating to Calibre Education for the month of February, but I've been through these. They all go into different journals that you would have covered if you're doing this series, the whole series on journals. There's nothing on this page that needs to go into the Debtors Allowance Journal. And then likewise on this page here, there's nothing that needs to go into the Debtors Allowance Journal. Before I get onto the Debtors Allowance Journal, I want to explain the relationship between our books and that of the school's books. Remember, we are doing the books for Calibre Education. Our customer, whom we sell to on credit, is the school. Now I'm going to take a transaction and I'm going to show you what gets recorded in our books and what gets recorded in the school's books, our customer. So we, Calibre Education, sold stock to the school on credit, 7,500. Now what happens is we issue a credit invoice. This was on credit. And on this document here, it says there's a sale from us, Calibre Education, to the school, 7,500. Calibre Education issues the O for original document to the school. Calibre Education keeps the duplicate. Now both parties, Calibre Education, that's us, and the school, record this credit sale. Now I'm only going to look at certain accounts resulting from this transaction to explain the relationship between the 2 parties. I'm using T accounts. So Calibre Education, in their books, they have now a debtor, and the debtor is the school. And in the books of the school now has a liability to pay. They have to pay Calibre Education. In the books of the school, Calibre Education is a liability, and in the books of Calibre Education, the school is a debtor, it's an asset. Now there was an increase after the sale of 7,500. On the debit side of the school, there's an increase in assets because the school owes us, Calibre Education, more, and the rule says increase in assets we debit. So the school in the books of Calibre Education gets debited. Remember the left hand side. But on the other hand, in the books of the school, Calibre Education, remember the books of the school, gets credited with 7,500 because the school owes Calibre Education more, increase in liability. Now what happens is the school is not happy with the products that they received, and the school issues a debit note. It's a claim for goods which do not comply with the order, because the school does not want to pay Calibre Education 7,500 because the school is not happy with the items that were delivered. So they want to debit this account, saying decrease in liability with a certain amount. We'll put in an amount in a moment. So now the school sends a debit note, which is a claim for goods which do not comply with the order, because they want to debit Calibre Education with, let's say, 1,000 or 7,500. We'll check the amount in a moment. Now, Calibre Education investigates the claim for the goods which do not comply with the order, and the school issues a credit note. Unfortunately, that's a little bit behind there, but I'll tell you what happens. The school issues a credit note for 1,500. The original goes to the school. Calibre Education keeps the duplicate. They're going to credit the school's account, decrease in assets. And what will happen in the school's books? In the school's books, the account will be debited. And when that is balanced, the amount owed to the amount owed to Calibre Education is 6,000. The amount that Calibre Education needs to collect from the school is 6,000. Hopefully that little diagram helps you understand the relationship between these two parties, these two entities, Calibre Education and the school. And what I did in this explanation was I looked at the books of Calibre Education and I looked at the books of the school. In the books of Calibre Education, the school was an asset, and in the books of the school, Calibre Education was a liability. So do you see how it is recorded differently in each set of books? It's important to understand this debit and credit, these debits and credits that are taking place. A credit note simply means you're going to credit the account, and a debit note simply means the account is going to be debited. But the documents that Calibre Education used in their books was, first of all, when they made a credit sale, they issued a tax invoice, a credit invoice. Then they accepted the claim for goods which did not comply with the order, and they issued a credit note. The credit note original and Calibre Education used the duplicate to record the return. So that's quite a mouthful. You might need to watch that a few times. But as we move on in the video, in the lesson, it will become clearer and clearer if you have this background to the lesson. So let's move on. In front of you, you have the credit note. Calibre Education has issued a credit note to one of their customers, or their only customer at the moment, the school, because the school returned a laptop that they weren't happy with. The laptop was faulty. And on this document here is the original sale that took place. Remember, Calibre Education sold a laptop to the school. The school's not happy. They're returning the laptop. Calibre Education accepted the claim for goods that didn't comply with the order, the laptop, and issued a credit note. And in red here, it says what's required to be on this document for it to be accepted by Revenue Services. And there's the total of the credit, 13,800. So the school's account, let's say, which was sitting like this, 13,800 on the debit side, is now going to be credited with 13,800. So the school is going to get a credit from Calibre Education because the laptop sold to them was faulty. And this is the document, just with different amounts. This was a faulty tablet, but without the red markings. The same thing. All the information of the credit is on the document. Calibre Education gave the school a credit because a tablet was faulty that was sold to the school. Which journal will this go into? The Debtors Allowance Journal, or Sales Returns Journal. This is what we're going to look at, the Debtors Allowance Journal. But what I'm doing here is I'm just comparing the Debtors Journal, which recorded credit sale transactions, and I want to compare the two because it's important to see the differences. Debtors control, that was an asset. When items are returned to us, that there would have been an increase in assets. This here is now a decrease in assets. Remember, you got columns for document day, and you've got here the debtor. There's the failure reference of the debtor. Now look at this. Output VAT. When we made a credit sale to the school, we collected output VAT on behalf of Revenue Services, SARS, and that was an increase in liability. And then there was sales and cost of sales. Now, this journal here, we need to reverse the output VAT. We're not going to pay over money to the Revenue Services if the sale actually got smaller or didn't take place, because we're giving the debtor a rebate, an allowance. So now what we need to do to reverse the output VAT, we go and debit input VAT. More about that when I take this information to the general ledger. and you had sales originally in the debtors journal, and now we're looking at sales returns. And then we also need to go and make amends in the cost of sales column. We only record in this column if the stock was returned to us, the physical stock. If the stock was damaged, it will not appear under cost of sales, because remember, cost of sales, that amount goes to cost of sales and the trading inventory account. If the stock doesn't come back, we cannot go and debit the trading inventory account, because we didn't get the trading inventory account back if the stock was damaged. So let's move on. So what I'm going to do now is I'm going to look at the two transactions that we identified needed to go into the debtors allowance journal, where the school returned items to us or got a rebate. So on the 10th, it says the school wasn't happy with the stock sold to them on the 9th and requested a 20% credit. We granted their request and issued them a credit note number 54. So the document is credit note 54. The day this transaction took place was on the 10th. Who's the debtor? It's the school. I've checked the folio reference in the debtors ledger. The school's account folio is D1. And now we need to get the amount. I checked the original sale. The amount was 3680. And we are agreeing to give the school a 20% rebate, because we issued them a credit note 54, saying that we're going to credit their account. So the amount is 3680 multiplied by 20%, which is 736. Now there was, like I explained earlier in the video, output VAT that was going to be claimed on behalf of SARS. That output VAT needs to be reversed. And how we calculate that is, we say 736 multiplied by the VAT fraction is equal to 96. And 736 minus 96 is 640. And in order to get the cost of sales amount, we say 640 divided by 1,4 gives us 457 and 14. So there we go. That's quite easy, just needs a little bit of practice. Remember from the lessons, this is supplementary to what you're doing. You need to go and practice. Let's move on to the next transaction and see what happened. I'll let it float in a moment. So let's see. The school returns stock to the value of 1,500. So I'll just say credit note number 55. We weren't given a number here, but I'm just working in number order. The date was the 16th. Who's the debtor? The school. Their folio reference is D1. The amount is 1,500. And once again, the input VAT amount is the full amount including VAT of the credit multiplied by 15 over 115 is equal to 195.65. What is the sales returns amount excluding VAT? It's the inclusive amount minus the VAT amount. gives you 1304 and 34. And to work out the cost of sales, we divide by 1,4, because remember, for this whole exercise, all these lessons on journals, the markup on the cost price is 40%. So we say 1304 divide by 1 plus the 40%, which is 1,4. And that gives us 931 and 68. If you're getting a little bit tired and you need a little break, go and throw a ball. Not in the street, maybe in the backyard. It's a little bit safer if you're fortunate enough to have a yard. Okay, let's move on. But if you need a break, pause the video and come back in a few minutes. Okay, we've moved into the backyard, and in front of you, you have the completed Debtors Allowance Journal for February, Debtors Allowance Journal number 1, and what we've done is we've totaled up the columns. And remember, the next step in the bookkeeping cycle is to take this information and put it into the general ledger accounts. You'll see we're going to debit cost of sales. We're going to credit cost of sales, and we're going to debit the trading inventory, and you will see why. I'm going to apply the accounting rules. Oh, and you guys are starting to flower. It's all making sense. Caleb, stop throwing the ball in the backyard. You're damaging my cosmos. Let's move on. So now we need to take this information from the journal and we need to post it to the general ledger accounts. Remember, the purpose of a journal is to take the load off the ledger. If an item or an account has its own column, we take the total, not the individual amounts, to the ledger accounts. So let's have a look here. I'm going to do trading inventory. I'm going to look at the B accounts first. That stands for balance sheet accounts. Statement of financial position as it's known today. So we're looking at two B accounts here. I've got trading inventory and debtors control. So as a result of these transactions taking place, I'm going to assume all stock was returned to us. And I have mentioned before, I would prefer it actually if the textbooks went and said cost of sales trading inventory, because this total of the cost of sales column goes to two accounts, cost of sales and trading inventory. Trading inventory to the amount of 1388 and 82 cents has been returned to us. Now remember, when we take this information to the general ledger, we need to apply our accounting rules. And if we get stock back, the value of our stock on our shelves has increased and the account gets debited on the left hand side. The date is the last day of the month, 2024, February the 29th. The contra account, as I explained in the Debtors Journal lesson, to trading inventory is cost of sales. That is the other account. So cost of sales would have been credited, trading inventory is debited, increase in the value of the asset. Where did I get the information? From the Debtors Allowance Journal. And what was the amount? The total of the column was 1388 and 82. And there you go. You're scoring marks. Now I've got the Debtors Control account. Debtors Control is also an asset. The school is a debtor. Remember, the control account in the general ledger is a summary of all the individual debtors. And the school has been credited with 2236 in total, and that means that the school debtors control, a debtor is an asset, a current asset. Remember, a current asset is an asset that is either cash or something that's going to be converted into cash within our financial year. Now, we're not going to receive this money from the debtor because their account was credited, and it's a decrease in assets, and the rule says credit the account. So on the credit side of debtors control, we have 2236. 2236. Where do we get the information? The Debtors Allowance Journal. Now watch this. There are two contra accounts to that 2236 to make our debits equal our credits, and let me show you that. In the details column of debtors control, we have sales returns and input VAT, because 2236, there it is, 2236, that is the credit entry. Decrease in assets, our debtors owe us less as a result of us crediting their account. The 2236 is the credit amount, and the debit amounts to make up the 2236 is 291 and 65 plus 194434. So the contra accounts are both sales returns and input VAT. That's why under details there's sales returns and input VAT. Both those accounts are going to be debited as debtors control was credited, but we'll look why these accounts were debited in a moment. And remember, the B stands for balance sheet, and trading inventory would have a failure. I think it was maybe B6 in our books. If you had the books in front of you, you could go check what the failure was on the trial balance, as in my previous lessons on journals. So there we go. We've taken the information from the journal to the trading inventory account and the debtors control account. We applied the rules. That is so important. Go and check my video on the rules, because once you know the rules off by heart, you're A for away in accounting. You shouldn't make too many mistakes. We haven't yet finished taking the information from the journal to the ledger. Here we're looking at input VAT. Now remember, the type of transaction that took place here was the school is returning stock or items that they purchased to us, Calibu Education. When we originally made the sale to the school on credit, we claimed output VAT in the debtors journal which needed to be paid over to the revenue services. Now what has happened here is, in inverted commas, the sale has been made smaller. So I'm not going to go and pay output VAT to revenue services when the sale has been made smaller. We need to reverse the output VAT. So we go and debit input VAT. And input VAT is an asset. The value of input VAT has increased. The contra account is debtors control. Where did we get the information? The debtors allowance journal. What was the amount? 291 and 65. And there we go. The account was debited. So input VAT, which is an asset, that information there now has ended up in the general ledger. And the last entry into the general ledger is the actual cost of sales amount. Now remember, this is the allowance journal, sales returns. So the original cost of sales is actually too big, the amount, in the debtors journal. Remember, there was an amount here, it would have been on the debit side, which resulted from credit sales. Now these are allowances, so the entry needs to get posted to the cost of sales account in the general ledger, and this is a difficult one to explain, but it's a decrease in expense, because at the moment the expense was overstated as, in inverted commas, you can say the sale was reversed or never took place because of the returns. So cost of sales needs to be made smaller. A decrease in expense, the account is credited. Where did the information come from? The debtors allowance journal. What is the contra account? Trading inventory. Remember, I said there should be in textbooks 2 names to this column, because that amount goes to 2 accounts in the general ledger, cost of sales and trading inventory. But we're only looking at cost of sales, which is an expense. It's a nominal account. N3, I checked on the trial balance, and the account cost of sales gets credited. So now we've taken all the information from the debtors allowance journal to the general ledger accounts, and that is the lesson. There's only one journal we still need to do, and that's the general journal. Then we would have done 8 journals of Calibre Education. I'm going to show you the general ledger, how to balance general ledger accounts, how to draw up a trial balance. Then we'll get on to year end, do adjustments. You guys are doing fantastically well. Keep it up. Get up nice and early. See a beautiful sunrise. Go to a beautiful place. Hey, and see where the road takes you. Have a great day.